It seems like it didn't start properly. Let's try this again. All right, testing. Is anybody out there? We'll see if this thing works. Sorry, somehow the start button wasn't. All right, let's see if this helps. We'll see if anybody can actually hear. Just say hello in the question box so we know that you're around and can hear it.
All good.
All right, and there we go. Oh, people can hear me. Fantastic. All right, so let's try the screen sharing. Screen. Yep. All right. People can see your screen. Yep, supposedly. Okay, it should come on any second. See if that does anything. La-di-da, la-da-da-da-da-da. Anything, nothing? Those of you who can hear cannot see. Is that what's going on? It does take a minute to catch up, but because it buffers. Okay, people are starting to get the video feed, I guess. Not everybody. Let's give it another second, see if everybody gets on board. Okay, all right, good. That seems to be good for everybody. All right, thank you, folks. All right, appreciate it. Now we can get this thing moving. So, start off professionally. Let's do the, oh no, where's my stuff? There it is. Let's see. Oh, I lost my disclosure. Da-da-da. Drag and drop your file, Control V, and hit it.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, nor its affiliates, nor any of their respective officers, personnel, or representatives, agents or independent contractors are in such capacity as licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OC website. Trade characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only based on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Okay, fantastic. So we are getting into the more interesting part of earnings season where we have winners and losers, and that's always a good thing. Helps us get a handle on what's going on. We played, cancel. We played the S&P short and picked up a couple of $1,000 on a nice dip. And also we played oil short and picked up, came down to here, picked up to $2,000 a contract on that dip because we started back near 85 yesterday. So very good. Obviously, we're going to bounce off 82.50, so that was a no-brainer to set for a stop over there if you hadn't already stopped out over here like I did. But you've got to realize, like, you're going to bounce off the significant lines. You're going to bounce off 82.50, off of 82, off of 83. All the big lines, but especially 82.50, 85, and 80 are going to be big bounces. So there's really no point to playing something to go through it when you're almost certainly going to bounce off a significant line. And oil, 83 was bouncy too. I mean, any significant dollar line in oil is going to be bouncy, but 82.50 is a major line because oil moves in $5 increments. So you got the 80, 85, and 82.50, all very significant lines for oil. And as you can see here, rejected at 85, comes back to 82.50, bounces. Now, how much of a bounce do we get off of 82.50? It's a 250 drop. 20% of a 250 drop is 50 cents. 50 cents is going to be your weak bounce. So the weak bounce from 82.50 is back to 83, and the strong bounce is 83.50. On the way down, 83 was good support. If 83 becomes resistance up here, okay, and we stay below it, then we're probably going to come back and test 82.50 and even maybe go back below it. So we'll see what happens there. But there's no particular catalyst other than we saw the oil report when it came out was kind of weak. Because they had a build, and we can take a look at that now. In fact, let's see. Petroleum status report. Wasn't really bad. So basically, is this the current? This isn't current. So you always got to read before you start doing it. Well, whatever. The current one's not out yet. Should be, but it isn't. But the highlights told us. So you got to make sure you got the right date. So the highlights told us we had a 4.3 million barrel increase in oil that was completely unexpected by these guys. And motor gasoline inventories decreased by 2 million barrels. So 4 minus 2 is 2.3. And then distillates were down by 0.4. So basically we had a net 2 million barrel build overall in oil. Nothing, certainly nothing bullish about that. Nothing that deserves to go to new highs. It's really blowing the demand picture. We'll see if we can find some more details out about that later, though, because we're not getting it there. And so that's that. And as far as the indexes go, you can go back to being you're supposed to be, which is the Dow, I guess. Oops. I think we talked about this last week with the futures. What, you can't pull up YM? There it goes. Hey, oh, look at the Russell took a nice dive too. So we talked last week, so I don't get too into it again. But when you're playing the futures, and so you say, well, Phil, how come you haven't played oil in a long time? Why not? Well, because we were below 80. Sorry, we were below 80. This is back going from September. We did play long into July, and then on July 4th we shorted, and it came back down, then it went up, and then it went down, blah blah blah. But then we lost interest basically. Why did we lose interest? It's in between. The low, the support is at the $65 line, and the resistance is really 75. But once 75 got crossed, there's no reason to play this. We don't know where it's going to stop. 85 is the next logical major resistance. 80 didn't hold. 80 we tried, didn't hold up. It had a little thing here, but 80 is okay for resistance if it holds up as resistance. But if it goes right through it and keeps going, then 80 is not resistance. Then we wait for 85. Then we look at the conditions. We look at how much oil, what the supplies are, what the reason for it going up is. And if those reasons don't tend to be supportive of $85 oil, we say, okay, well, here's a good spot for it to turn around. How much is it going to turn around? Well, we had to run from 65 to 85. That's a pretty significant run. That's 20 bucks. So we're going to see how much. We're going to see a $4 retrace from 85 back to 81 is what we're going to be looking for. Did we have a retrace along the way, though, that would have made it stronger? Yep, we had a pretty good consolidation at 70. So maybe we shouldn't be using 65. Maybe we should be using 70. In that case, 70 to 85. And how did that work out? Do we have any consolidations here? Just this one at 70, at 80. So 70, 80, we had a consolidation. In fact, it was exactly around where it should, it's exactly where it should be. 70, you got a $2. From 70 to 80 is $10. That means $2 pullback. So 78 over here and 76 right about there. Those are your pullback zones. So we hit both of those. So we got to 80, had a retrace, came back up, went right over 80 though. That's bullish. Now we get to 85. Did we have enough of a pullback here to call this consolidation at 75? Not really. So I would say we'd still want to play the broader zone, but at least 70 to 85 or 65 to 85. So somewhere in the neighborhood, let's call it 70 to 85 and be pessimistic. That's 15. You're still going to have a $3 retrace. And that would take you down to 82. So you're looking for at least 82 on a pullback from 85 because you've got all these different zones that are all pulling back, waiting for some kind of correction. And until you get it and until you consolidate off your correction, you haven't worn out the sellers. And why is that? Because smart money investors take profits. They don't let things run forever. Therefore, the programs that they use, the trading programs, are programmed to take profits at certain levels. That's what the 5% rule identifies. Where are these profit-taking levels? Where are the levels where they're going to come back in and start buying again? That's what we're looking at here. But the rule itself only tells you where support and resistance is going to be. You've got to pay attention to the actual news flow to see what's actually going to happen. So we had some pretty good draws along here that helped us come up, and we had the OPEC noise and things like that. Now that story's run its course, and now they've got to play off the actual inventories that are coming in. They're not that great. In fact, just this morning, if I can find it, home. CUSH. What? Really? Well, that's so nice. Let's see. Cushing inventory. There's news. Okay. Okay. So you see these stories. I posted one today. I don't think it came out or something, but anyway, oil inventory at Cushing crude hub is historically low. WTI spreads at Cushing, blah, 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 blah. Now, Cushing, Oklahoma is not a life and death thing for the United States oil. We have 6 different pad zones where they store oil for the interim, and they're constantly being filled and emptied. It's not like when you run out of oil at Cushing, you're out of oil. And also, this is something that's a controlled burn. It's partially being caused by distribution issues because of all the shipping problems that we're having around the country. That's causing some problems getting it restocked. But in other words, it's not there, it's here. Oil moves around the country. It's not like we're running out of oil. It's not like people aren't getting deliveries and so on and so forth. Would it be bad if Cushing completely runs out of oil? Yeah, of course it would. But it's just low. It's not out of oil. In fact, I read some idiotic article that said, well, it doesn't have to be empty. Even if it's half empty, then it's going to be harder for them to pull the oil out because it relies on the pressure of the oil. You know, the weight of the oil on top pushes it through the pipes. And therefore, if you don't have enough oil on top to wait to push the oil, it becomes harder to move the oil in and out of the system, blah, blah, blah. It's just all bullshit. And it's what it is. It's PR spin. They're spinning these articles. The reason you see article after article after article telling you this stuff is because they want you to believe this. This is their excuse for bringing the oil prices up. They got to have something to point to. It's not demand. We aren't showing any kind of great demand thing. So they're trying to tell you that this thing is empty, and they're extrapolating, which we know is bad, right? They're extrapolating the fact that it's gotten emptier, and therefore it will continue to get empty until it runs out of oil, and then we're all going to die. These are all ways that they use to scare people into buying oil and overpaying in the front months. And meanwhile, the funny thing is, the oil contracts are for delivery from Cushing. So if you have an oil contract and Cushing has no oil, they would declare force majeure and the contract becomes worthless. So what do you gain by buying oil contracts that are for delivery at Cushing, Oklahoma? If the oil isn't coming to, the reason the price is going up is because there's a shortage at that specific place. So it's really kind of an insane system, and they're using it. They're just manipulating it to their advantage. Basically, it's really crazy. So, what does this say? Stockpiles at the biggest depot are quickly approaching critically low levels. Storage tanks in Cushing require a minimum oil level to maintain normal operations, which traders generally believe. Like, this is not a fact. Could you imagine like having this thing that's holding billions and billions of dollars worth of oil, and they go, well, we think if we're under 20 million barrels, it becomes a problem. And again, that's what I was talking about. Half the storage is gone. Usually this time you hear stockpiles decline more than 4 million barrels over the past 2 weeks. 31 million barrels expected to keep dropping rapidly as the world's insatiable demand for U.S. light sweet crude. This is not at all true. Cushing supplies the U.S. pipelines with light sweet crude for the U.S. refineries. It has nothing to do with global demand. Nothing at all. Now, since this person, Devika Krishnakumar, writes for the World Oil magazine, you would think that she, I imagine, knows this. You would think that they understand how this all works. But they just reiterate what they say whatever they're told to say. Somebody else writes it, and they put these junior reporters on it. Here, let's find out who this person is. Who is Devika Krishnakumar? Who is, get to know your propagandist, we call this segment. Oh, it's a guy. Look at that. So, hello 85 WTI. Haven't seen you in 7 years. He visited some friends in Cambridge, so he's not very old. He writes for Reuters. And he's got a LinkedIn profile. Oh, that's another Devika Krishna. Could be her, because one of these people. Bloomberg hires Devika Krishna Kumar. This person really gets around. That's a her. No, she's the genuine one. He's not the one. But interestingly, he also has an interest in oil. This is very confusing, unless maybe that's her boyfriend. Who knows? Oh, I see. She recently left Reuters and went to Bloomberg. Very cool. She moved from her role at Thomson Reuters in New York as a commodities expert, can be followed on Twitter, blah, blah, blah. Okay, let's follow her on Twitter. Let's see what she does. What are you doing? Oil markets correspondence. So she's obviously young. June Bloomberg, financial oil, I live in London, blah, blah, blah. A culprit behind latest oil, Bloomberg. Dwindling supply at U.S. hub is rippling into the global markets. It's the same article. Traders are fretting that stockpiles in Cushing will. You see, this is propaganda. This isn't news. This person is hired to spread propaganda from outlet to outlet. It's insane. This is how it works, folks. Major attrition, employee told what? Oh, that's Exxon. Exxon boosts salaries. Oh, see, that was her. Just was a picture of a guy for whatever reason. She has friends in Cambridge. That's nice. So she's recently out of college. Okay, anyway, so this is a person who writes for Reuters, this is a person who writes for Bloomberg, and it's the same article over and over again, but now she puts it in different outlets. It's crazy. It really is. These people are spouting out propaganda, and whether it's because, here you go, back here, October 22nd, tank bottoms by the end of the year. The market increasingly thinks it's possible. Stockpiles, blah, blah, blah. Pushing the $100 barrel agenda. And you see a lot of this when oil prices are going up. You see a lot of these articles come out, and if you look back at them, you see the same 4 or 5 people writing articles over and over again, telling you. And who are these people? They're people associated with the industry or who've been around the industry or are very young, and they'll just rewrite, they'll just put their name on. They're happy to put their name on anything. PR. So a PR person gets them an article, says, put this up here. This has all been researched, blah, blah, blah. Check it out. They can check it out, but it's really, like I said, it's extrapolation and hearsay. How can you sit there and say, wherever that article went, we lost it now, but how do you say that what kind of reporter for Bloomberg oh, there it is. What kind of reporter for Bloomberg says traders generally believe 20 million barrels is required to maintain normal operations? Don't you think you should ask the guy at Cushing who's an engineer and how much what maintains normal operation? Isn't that how articles really work? Not vague bullshit. You just got to realize what it is you're being fed here when you see this stuff. It's a stunning reversal from last year when the pandemic prompted a glut, blah, blah, blah. Crude oil could justifiably trade to the next level or higher, said Bob Yorger, director of futures at Mizo, blah, blah, blah. Rapid depletion of Cushing signals tight global supplies. Okay, rapid depletion of Cushing signals a tight global supply. Why would that be? Does that make sense? Okay, we import, the U.S. imports, and this goes back to, where's our report, right? Let's see if this came up. October 15th, no, okay. Anyway, even so, though, we can still look at this. The United States imports from all over the world, imports a total of 4 million barrels a day. Out of 20 millions of barrels a day we use, 4 million barrels, not even 4 million barrels, but not to be picky, is imported. We export 2.4 million barrels of product. So basically, we're importing this oil to refine it and export it to other countries. So as a net balance, only 1.2 million barrels a day, 6% of our total consumption is imported for our own use. In other words, we import for other countries to make them products as well. But for our own use, only 6% of the oil is imported. Cushing, and here's the problem. I mean, anybody who's a real oil reporter would know this. Cushing is a hub. Oil is delivered by ship to not even a Cushing. I mean, oil is delivered to the Gulf of Mexico, and the pipes run to Cushing, which is a storage facility in the U.S. for distribution of oil in the U.S. It's a distribution hub. It is not a place that sends oil to other countries. Demand in the rest of the world has not a thing to do with what's going on in Cushing, Oklahoma. That's what's going on in U.S. demand, okay? And one of the reasons that Cushing has drawn down is because other terminals that are closer to the Gulf Coast were shut down due to hurricane activity, and therefore Cushing used their inventory up while the other terminals were not functioning at full capacity. And that's what the story is. Has nothing to do with any of the bullshit that they're saying in that article. And this is not complicated. And again, like I said, it's such complete crap when you can't pick up the phone and call the engineer at Cushing, Oklahoma, and say, "Excuse me, sir, what actually happens if the oil goes below 20 million barrels? Is that a problem for pumping oil and so on and so forth?" And you know he's going to say, "No, that would be stupid. Who would design something that way? Who would design a 40 million barrel tank that if it goes below 20 million barrels, it stops functioning? Who designs it? Is that how your water tower works in your town? Is that how anything works? Is that how your gas tank works? Do you think they can't figure that out? We have gas tanks in cars. They run all the way down to empty and they still keep pumping out the gasoline. Do you really think that we're such poor designers that a half capacity tank in Cushing, Oklahoma stops producing oil? That's the premise they're using to try to convince people that we're going to run out of oil at Cushing. And they're also trying to convince you that if we run out of oil in Cushing, we're all dead in the water. Nobody else can pick up the slack. That's a huge gaping infrastructure problem, isn't it? Then what about the Strategic Petroleum Reserve of 600 million barrels? Don't you think that let's keep in mind, Cushing, Oklahoma, 40-something million barrels. So if we have 600 million in here in the Strategic Petroleum Reserve and another, what is this, 4, 8, 10, another 1.2 billion barrels in private reserves around the country, how is plus or minus 20 million barrels in Cushing, Oklahoma going to crash the economy? Stupid. All right, anyway, so hence the oil short. And this is what, this is what I was pointing out. You have to read the news and you have to look for stupid stuff like that. You have to look for like mistaken premises and false assumptions. But to do that, you have to actually understand the mechanisms under which things work. And I'm not saying you have to be an expert in everything, but play the things that you're an expert in. Okay. I've told this before, so bear with me if you heard it, but I didn't start out being an expert in all these different things. I'm not an expert in everything, but I know a lot about different things. But why? Because my father was a systems analyst. So I've had computers in my house since they were like the size of refrigerators. And, the computer was like a refrigerator turned on its side, like it was gigantic. And it was so hot, you could like fry an egg on it. It was like really, really hot when it was running. And but we had a little tiny green screen to look at things on. It was a great big computer and seen a little green screen on top of it. So we had the first computers in the house. So I've been around them forever, and you had to fix things yourself. So I learned from my dad, and also back in those days, they had very large transistors and tubes and so on and so forth, and you would fix everything yourself. So I learned how things worked, and then as computers improved, it was very natural for me to understand the workings of computers. So I knew a lot about, I understood programming, I understood computers. And what happened is when I started investing, that's why I started. My grandfather was an investor. I learned a lot of stuff from him, general business stuff, but my expertise was computers. And I had that core expertise from wasn't a career as a kid, but I'm going to college, that's what I understood best. In college, I studied advertising, international business and advertising. I had a double major. And I got very interested in advertising. I was going to go into advertising, in fact. And but it turns out advertising is a really shit profession. It's really much less creative than you think it would be. So I knew a lot about advertising, and so I one of the things I started doing when I started investing in college and out of college, is I would start investing in the chip companies. This is in the early 80s. So we're miles away from .com. This is when I got out of college, and then the mid 80s when I got out of college. So I would invest in things like Cray Computers and Intel and National Semiconductor, things like that, Texas Instruments. I would invest in what I knew. But then, because in being diligent about my investments, I'm sorry, with advertising. The other thing I would invest in, though, with advertising is I used to read Advertising Age. And, back then, nobody read Advertising Age except for people who were in advertising. But I realized, like, reading Advertising Age, and because I learned from my grandfather the advantage of knowing what's going on and understanding the information, I realized that by reading Advertising Age, I was hearing about campaigns that were going to be run months in advance. Like, they would be talking about who they're getting on board for McDonald's big spring campaign, which is going to be this and that, right? Well, that's an interesting thing to know. And back then it was basically, if you didn't subscribe to the magazine, you didn't hear about it anywhere. It wasn't a thing. It was only for industry people. So reading Advertising Age every week was something I started doing, or was it daily or weekly? Anyway, I read it all the time. So reading Advertising Age, I would always look and see who's got campaigns coming up, who's doing a lot of ad spending, and who's having a successful campaign. It would also tell you how successful is this campaign, what are the metrics running on these things that they're doing, and then you would figure, okay, does that translate into more sales and more profit for the company? Is that going to be a good move? Some people have failed campaigns, some people have successful campaigns. Advertising Age knew this a long time before they would tell the shareholders. In fact, and I'm not saying they're hiding it from the shareholders, they don't know. The way companies were back then, you didn't get immediate feedback. You would hear from Advertising Age would tell you their campaign is failing, probably before they even have a board meeting to talk about how their campaign went. The advertising executives knew that the campaign was failing. They're like, oh, well, they spent all this money. It's just not working. It's not really seeing a throughput. And Advertising Age is looking at it from the perspective of what kind of ads work and what doesn't and what kind of things get responses. That's what they're interested in. And technically, they shouldn't have been talking about this stuff. Probably from a company perspective, it's sort of insiderish information because they weren't looking at it that way. So the advertising people weren't thinking about the stocks. And the stock people weren't thinking about the advertising, but it was incredibly good information to know in advance. So I would look at that stuff. I would also stuck to my specialty of chip stocks and computer stocks. And when new companies came along, I said this will be hot, this is good. Microsoft, IBM, so on and so forth. You could see what was going to sell and what wasn't. Well, I could easily, because I understood that part of the business. But then I would invest in a perfectly good company and it wouldn't do well. Why didn't it do well? Logistics. Something would go wrong. The perfectly good computer company, why isn't it doing well? It's not doing well because of logistics. Then sometimes they wouldn't do well because of politics. Sometimes there was trade deals in effect. Sometimes there were blockages of technology and so on and so forth. So I started branching out. And so from my knowledge of computers, I started getting a big interest in logistics, and I started looking at logistics and how they worked. And I started getting into all those companies at the times, really, FedEx, UPS, and then the local truckers. And then as that grew up, and that became a good investment too. But then I started learning more about them. They were very connected to the retail, and retail also mattered a lot for the computer companies that were coming along, as they were trying to sell in the stores. That was a new thing because they never sold computers in stores before. Now I had to learn all about the retailers. Then I started learning about the retailers, but then the logistics companies, there was, here and there's problems. What are their big costs? Oil's a big cost. I started learning about the oil market. But what I'm saying is these things, they all grow one out of the other logically from what if you start with what you know, and if you start with what you understand, it's very easy to build the bridges to the things that you don't understand yet and start learning about them because it connects. So in other words, if you want to learn about the nervous system, if you understand the brain really well, then it's easy to learn about all the parts of the nervous system because you know what the brain does and you know how it reacts to things. So then you say, oh, that makes sense. Okay, so it takes this input here and does that, and this sense does this, and this sense does that. That's how you learn because you understand something and you build from the rest. It's like a Rosetta Stone, right? So, so this is, and so the bottom line is, this is my advice to you guys is, when you're investing, it's like invest in the things you really understand well and use the things you understand well to learn about the next thing. Don't just jump from thing to thing to thing. Don't just go, oh, that sounds interesting. It's not like that. You should really start with your base of knowledge. Like almost all of you guys is like, you have some specialties. You should really be in your specialties and learning how to all the things about trading in your specialty, and then you can branch out from there to the next thing and the next thing and the next thing, and everything is connected ultimately. All these things are connected, and that's one of the reasons I got so heavily into politics. Politics touches almost everything in the end. And you've got to understand that relationship on the macro level. So in other words, underneath or not underneath, above everything else is the politics, it's the geopolitical concepts. That drives so much of what happens in the market, including whether or not people make profits, including whether a company makes money or not, including whether a company is allowed to sell a product in a certain market. Look at China Telecom. They just got banned from the U.S. over politics. Huawei got banned in the U.S. I mean, yeah, China Telecom got banned. Huawei got banned. You realize the United States is into like banning companies now? That's what we do to protect. We are protectionists, and we stop companies from competing in America, and we ban them from doing business here. And we say it's because of spying. Okay, why not just ban the spy chips? Why not just test the products and check them out and make sure they're not putting in the spyware? Why ban the product? Oh, we heard you guys spy, so we don't let you sell your products anywhere. That's not a proper policy. That's not encouraging free trade. That's not what we pretend America's about. And what happens then? Then there's retaliation, and we can't sell our chips in other countries. Well, in reality, other countries buy more chips than we do. We don't buy the most chips. Apple does. Apple buys the most chips on the planet, but they don't make them here anyway. But they can't bring them back here if it's a banned company, so they can only buy from certain people. But there's still plenty of people to buy from. But at a certain point, it starts hurting people's ability to do business. So yeah, politics matters. All that stuff matters. All the things that these people do matter. It conducts the way you conduct your business, the way you run things, the way you're allowed to do business, the way you can expand, the way the economy goes. It affects the economy, then the economy affects your business. It's all tied together. But the thing is, like I'm saying, it's a convoluted base of knowledge. So you say, well, Phil, why do you know so much about how Cushing trades? It was important. It was important in a lot of ways. The price of oil affected a lot of things, so I wanted to find out how it worked. I learned a lot about how oil works. I worked with traders down at the NYMEX. And back then it was cowboy days. I mean, basically you could just go places and go check it out. And if you're interested, you can just go find out how things worked. Everything's so closed off now, like everything's like a little club. But 30, 40 years ago, it was just like if you were interested, there was always somebody who's willing to give you a tour. So anyway, so you learn things along the way. That's what I'm saying. And that's why, so I'll explain something to you like that. And you're like, oh, that's pretty, how would I know that? But if you don't know that, don't trade it. Don't play with things if you don't understand how it actually works. Like when you read an oil report, it's got to speak to you. You've got to understand what it's saying. You can't just read an oil report and look at the surface of it because it's not going to tell you enough. And you can't read these articles and just take them at their face value. You got to be able to think about the mechanisms that are involved in getting this stuff done. And that's how you decide to trade. And like I said, so when I'm trading the futures, I'm looking for a zone, but then I'm going to look for like, why do I think it's going to be short here? Why do I think it would come off? What's going to give me the indication? And what day do we short? What day? Well, Wednesday. Yeah, we're shorting into the oil report. So we wanted to short at this $85 line. If we cut this down to hourly, that was the correct line to be shorting at. And I reiterated this yesterday. We didn't quite get back to it, but that's why I started 84.75 was my in. And I was willing. We only had 2 short oils, and the reason we only had 2 short oils is because we never got to 85. So I started at 84.75 with a couple of shorts, and I was very happy to see. Hopefully, it would go back to here, and we short 2 more and average 85. That was my goal, but didn't quite make it. Anyway. So do we want to short again? Well, now I'd have to have a reason. Now I have to, because now we're no longer at the tippy top where I really feel comfortable shorting. So do I want to short more here? Not really. I mean, not that I don't think it's going to go lower, but now that I've made the money and we're out, it's going to be hard to get me back in just because it inches down. If it breaks a key technical like 80, below 82.50, you could start again, but I don't have the conviction I had at 85 to keep with it. Not without more information, not without something else being a catalyst to send this thing lower. Now, Robin is saying this has nothing to do with what we're talking about, but Robin is saying on money management, how do you handle the cash you put aside for puts? All right, well, that's interesting. So let's take a look at cash we put aside for puts, like in the long-term portfolio. Well, I'm not sure what she's saying. That would have to be clarified, I guess. But let's assume we know what she's talking about. No, I do not want to take a survey. Although I'll tell you, they did do what I asked them to do. They did these surveys. They actually listened to me. I told them that we needed more legs. They used to limit it to 4 legs, and I said, look, sometimes we do 5, 6 legs. And I said, why would you have an arbitrary limit of 4 legs? And they fixed it, which makes me so happy, especially in my butterfly trades. All right, so Robin says, how do you handle the cash you put aside for the puts? Okay, if she asks that, if you mean literally, how do we handle the cash? In other words, here's a put and here's $7,000. It just drops into the portfolio. So I don't handle it or think about it. But what I do handle is an allocation block. So in other words, this is a short put on Apple. It has an allocation block. So if I'm going to sell 10 short puts, I'm obligating myself to buy 1,000 shares of Apple at 105. So it's 105,000 less 7 is $100,000 basically. Of Apple. Now, from a margin standpoint, that's going to cost me $50,000 in margin. It's going to cost me, and again, figure half. It's not necessarily because it's a portfolio margin, but without doing anything else to it, it's going to cost me about $50,000 in margin. How much is my allocation block in this portfolio? My allocation blocks in this portfolio are $100,000 each. We have 20 $100,000 allocation blocks. Now, they could easily be 200,000 because we have $4 million of buying power in this portfolio. But the point is, that's what I care about the most, is how much of an allocation block is this trade using? So this trade is using effectively half of $100,000 allocation block, which I prefer to stick within $100,000. Although already I know Apple is an exception, and I would gladly let it be 10% of the portfolio. I could care less if Apple is $200,000 of my portfolio. In fact, I'm happy if Apple is a large chunk of my portfolio. So there's the cash, which drips into the portfolio and becomes part of the total down here. It just becomes part of the cash pile in the portfolio. What I'm much more concerned about, though, is how much of an obligation, what are my allocation set-asides for these trades? And so when I have something like that, I would consider this $50,000 of buying power set aside for Apple. All right. Now, am I worried I'm going to lose $50,000 on this trade? That becomes a factor too, though. No, not at all. I cannot even imagine a scenario in which I would lose $25,000. In other words, for me to lose $20,000, Apple would have to drop to from 98 to, let's say, 75. So it has to go down to $75 a share. Do I believe Apple can go from 150 to $75? And then my 1,000 shares would be worth 75,000, and I bought them for 100,000, and I'm down 25,000 in cash, still only down 12,000 in margin, but I'd be down $25,000 in cash, and I'd lose $12,500 of buying power. Do I think that's even likely to happen? No, of course not. And if it did happen, what would I do? I'd buy a lot more. You're going to sell me Apple for $75? Yes, please. Okay. What do I want more? Do I want AWW? No. Do I want BCS? No. Do I want CIM? No. Do I want coin? No. I will dump all of these things to buy more Apple at $75. I already know that. I will cut every single one of these. Is there anybody I want? Okay. FedEx, maybe. We're imagining that there would have to be a massive crisis where the market crashed 40, 50%. So would I maybe stick with FedEx? Yeah, maybe I'd stick with FedEx. Biotech, yeah, maybe biotech. I don't know about that one. Can't guarantee it. Moderna, no, probably not. Mattel, no, probably not. Micron, maybe. Pets.com, no. Vail, blah, blah, blah. Okay, so I would dump all of these and free up all of my buying power so I could buy more Apple for 75. So I already know that. So all these guys are gone before that happens. That's the point. How much am I going to lose? How much is it likely I'm going to lose? And here, look, we've lost 24, 25, 20, blah, blah, blah. Here's some losses right here. But am I worried about them? I sold the Xerox $25 puts for freaking $7.85. All right. Now, unfortunately, that puts me down to 17.15. So we were almost there. Xerox took a hell of a hit recently. Take a look at that. Yep, there you go. So Xerox apparently had really bad earnings, weren't paying attention, and even if we were paying attention, what are you going to do about it? We'll see what happens. But our net entry is where it is now. So we're not losing money. If we could take the loss now and panic out, but we're not losing money. This is the beauty of selling puts that are so far out of the money. Here's Vail. We have a net 12 entry and it's at 1366. So should we take the $2,500 loss? No. We really would like to own it down there if it stays that low. But still, even so, if all these turn negative by $2,000, $3,000, $4,000, let's say they average a loss of $3,000 each. So that'd be well, it says here 19. So that'd be 18 of those times 3,000 is like $54,000. So let's say the market crashes and we stop all of these out with an average loss of $3,000 and we lose $54,000. That would be my loss of all these puts. Now, the nasty old Apple puts would be there and they draw a $25,000 loss. So now I'd be down $75,000 just in the short section of my portfolio. But now I can buy Apple for $75. I don't consider that a bad thing. Would I take $75,000 of my $1.7 million in order to get the right to buy Apple for $75? Yeah, I'll buy more than 1,000 shares. It's going to be worth it to me. I'll buy 2,000 shares. I'll buy 3,000 shares. I'll have an app. My portfolio will be called the Apple portfolio at that point. So yeah, and it doesn't have to be Apple, but the point is in this particular set, that would be the one I would absolutely keep. There's no question I would stick with it, no matter what price Apple goes to. So so the question goes back to, am I worried about taking a loss on this position? No. So honestly, I'm not even really going to count that as taking up an allocation block because I know I'm going to keep it no matter what happens. So I'm not going to take a loss. I'm not going to do, all I would ever do with this is buy more. Each position you look at. On BCS, it's 10 minus 210 is 790. They're at 11. CIM is 15 minus 3 is 12. They're at 15. Coin is 200 minus 45 is 155. They're at 300. It has to fall 50% before we actually take a loss. That's how these work. So it's a combination of how much could you realistically lose? How much could you possibly lose if the market dropped 20% tomorrow, which you can't because circuit breakers kick in, right? But in 9/11, we learned a very valuable lesson. We learned that the market can close and not reopen. And when it reopens, it can drop so fast that the circuit breakers kick in before you can sell because you call your broker and the broker can't, the phones are all busy, the lines don't work, and the machines don't work. So what's the value of these breakers? By the way, what is the value of these breakers? Because the freaking top 1% can trade. Who do you think gets to trade when the market is completely collapsing and they hit the circuit breakers 5 minutes after it opens? That's everybody. That's all the top trade guys. That's all the #1 top billionaires in the world. They call their brokers and they damn well sell their stock at the price they want. They sell it way before you're ever going to get a chance to. In a couple of days, you'll get a chance to trade. They're trading now. So yes, the market can drop 20%, 30% before you're really going to get a chance to react to it. This is why it's important to always have hedges. Because God bless your hedges in those situations, because then your hedges pay you back most of what you lost, and you still have cash. That is the real value of hedges, is for disaster. So what was the question? So anyway, so the catch, right? So the combination thinking in this situation is that you have to think of your positions, there's no like, oh, I set aside this much money for this. It's because Apple is not a set aside because I'm not worried about Apple. And obviously I have enough money where I can say that I'm trading within my means. It's not stretched to the limit. All these other guys, I could foresee, if you want to get to the nuts and bolts of it, I could foresee taking a $5,000 loss here before I stop out. I could foresee losing 3,000 here. I could foresee losing 2,000 there. Each position you say, what would my cash loss be before I stop out of this thing in a worst case scenario? And also, how much pain am I willing to endure? How low would it go where I still feel comfortable holding this position? And in the case of Moderna, it would have to fall more than 50% before I'm even a little bit uncomfortable with the position. And I don't see that happening. I'm not worried about it. So that's a not a set aside for me. That's something I would probably put more money into realistically. Here's Levi's. I'm not gonna get rid of Levi's. It's 27 minus 7 is net 20. It's at 26. So it's only 1,000 shares. So if it went to 50, I'm net 20. If it went to 15, if it dropped 50% from where it is now at 15, I would be down $5,000. I'm in for 20. I'm in for net 20. So I'm in for $20,000, and it would be at 15. It would be $15,000 value. Am I worried about owning Levi's for $15 for the long haul for the next 10 years, for the next 20 years? No. Not unless there's a virus that makes everybody's legs fall off. Because as long as people have legs and the economy isn't at zero, they're going to buy Levi's. So I cannot foresee a situation in which I don't want to own Levi's trading at half the current price. I just don't see that as something I would sell. It doesn't make any sense. What could possibly happen that would make me say, oh my God, they're never going to buy Levi's again? That's the end of that. So it's each one is individual, and those stocks, you should feel that way about the stocks that you're selling short puts on though, because you are stuck with them. They are bets like that. But those aren't the only short puts. The portfolio is full of them because most of these positions started out as a short put sale, and then the put went 40% in the money or lost 40%. And I said, Vail got really cheap. We're in for net 12 and it's at net 13. So now I got to go look at Vail again and say, what the hell happened to these guys? So I'm going to reassess my position here. And I'm going to say, what the hell did I do wrong? We went into Vail in September. So very recently, Vail fell apart. What has changed from September when we thought we were getting a good price to now? So it's got a $67 billion value now. They're projecting to make, oh, frick. Oh, this is in reals. Oh yeah, Brazilian, these are reals. 83, well, I gotta do it, 83, 111, reals in dollars. So 14, not millions, billion, right? Yeah, those are millions. Yeah, I thought so. Okay, so anyway, so these are billions, and the number turned out to be $14-15 billion profit on a company that's valued at $67 billion. It's stupidly low. Oh, and there it is. In fact, they did it for you here. They did it correctly. It's 4.3. So the PE ratio is 4.3 dollars to the dollar market cap. This is a perfectly good company. Nothing is wrong. What's wrong is the price of copper has dropped recently. It is nothing to do with this company or the way they conduct their business or anything else. So if we look at copper, here's what happened since September. Actually, there's no change. Actually, copper went up and then down. So it's actually higher than it was when we came in, but it recently has dipped considerably, and the stock sold off considerably on the dip, even though honestly not a big difference. So then you got to say, well, did the company say something? Did something like did they say, oh my God, we don't know what we're doing, we're going to die? You know, you have to assume something happened, right? Not that Yahoo. Yahoo. Oh, that one. There you go. So did they just have earnings? Oh, here you go. No, what's in the cards? Vail or like blah, 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 blah. For dividend date, kind of confusing here. Vail gains as the market dips. Brazilian Maya Vail, blah, blah, blah. Interesting. I don't know when their earnings are. October 28th. Oh, isn't it like tomorrow? Yeah, tomorrow. Consensus for the third quarter pegged at $14 billion, indicating growth, 30% growth from last year. Consensus mark for earnings is they should make $1 billion in earnings for the quarter. For the quarter. From the prior quarter, the estimate has gone down 29%. So estimates have gone down 29% over the past 30 days. So estimates were moving up because people were incorrectly thinking copper prices would just go up and up and up. All right, fine. So bottom line is, does this change my view of Vail? And the answer is no, it does not. I really don't have a changed view of Vail. I think they're perfectly fine. They're certainly fine at $12, and that 12, which is where our entry is going to be. So honestly, on the whole, I would love it if they actually missed earnings, went even lower, and then we could buy a bull call spread. But either way, this is the kind of stock we're going to certainly add a bull call spread to. But we're going to wait for earnings and see what actually happens. What really is the deal? Not only that, though, but these are 2023 puts. So the 2023 15 puts, and speaking of advertising, so the 15 puts are now $4 or something like that, or $4.50, let's say. They can be dropped to the 13 puts for basically an even roll. So now my net goes from $12 to $10, and they're at $13.67 now. So we have another 30% drop ahead of us before we're in big trouble. As to a spread, oh my God, look at this. You can buy the 13, which is at the money. You can buy the 13 calls for just $2.25. I don't even know if I'd bother covering those. $2.25. So we could add, depending on how earnings go. So if earnings cause them to spike down and we still think it's a nice buyable stock, maybe we'll buy the $10 calls for close to $3. Maybe we'll buy these for under $2 and just let them ride. And then we got 2 years for Vail to recover. And then do I want to be in Vail like that? Well, I mean, unless something crazy is going on, they are an up and downy kind of stock. They move up and down in a channel. This would be very, very low. Something around 10 would be very low in their channel. And most likely, if we wait a couple of years, we're going to see a price that's going to come back up. So yeah, I wouldn't mind being in this stock. I wouldn't mind owning it. And even better, when you look at the way the options are structured, if we do end up in, let's say, the 10, and let's say we end up selling these guys, which is the 15s, they're 150 now. Let's say we sell those for 2 eventually on a little bit of a move up, and we buy these for let's say 350, then we'd be in for net $1.50, right? So now I say, okay, so we're in for net $1.50. What can we sell January calls for? Well, I could sell the January 15s for 30 cents. No, that's the 16, sorry, 50 cents. I can sell the January 15s for 50 cents. That's 86 days away and $1.50, 10% out of the money. And I can get paid 50 cents for that. I can do that 10 times and get $5 back on my $1.50 spread. So if I end up in a situation where I have to start doing some put selling, some short-term call selling, I got no problem with that. I got a very good chance of making my money back anyway. So lots of ways to win. Hard to imagine how you're going to lose. Okay, and you look at Vail and you think about what they do. They do bulk materials and base metals. So they actually, though, that's the other thing. They are a huge copper miner because they're such a huge miner, but most of their mining is not even copper. Copper would be in with the base metals. Bulk materials is what they make most of their money on. So unless there's a massive slowdown in demand for bulk materials, which is unlikely with all the infrastructure projects that are being pushed around the world, they're not going to be affected by a drop in the copper price anyway. People just don't understand what they're investing in. They know Vail does copper, but it's only 15%. Only all metals are only 15% of their total valuation. So it's mispriced. So that is my answer to the question. What do you do with these puts? Every single one, you got to do that. You got to reevaluate it. You've got to look at it again fresh, and you've got to say, do I want to own this thing? What am I going to do with it? It's down 40%. I don't care about the 40% because I know that's all premium. What I do know is I said I would buy 2,000 shares of Vail for 15 minus 3 for $12. So I'm obligating myself to have $24,000 worth of Vail, which is a quarter of an allocation block of Vail. Can I live with that? Do I feel comfortable with that? Yes, because I could cover it, and I could also find other ways to make money, like selling short calls and things like that, that'll bring in more money. So I have zero fear of being obligated to own this thing. I think they're a perfectly valid long-term miner. Nothing particularly bad happened. They turned in perfectly acceptable earnings. They just didn't do quite as well as people thought they would in the last quarter. People had higher expectations than they hit. But overall, they made solid money. They're well worth earning at this level. So that's what you have to do. You've got to look at all of your stocks and think about how much of an effect is it. And if you don't like something, or if you don't like the concept, you say, "Well, I don't want to own Vail." Look at what happened to look at builders and housing and slowing down and whatever real estate. None of that's true. Not commercial real estate, housing, everything is booming right now as far as building and using materials. But if I felt that it wasn't the future and it wasn't worth it, then I get out. I take my $2,500 loss and quit. Nothing where you sold a put should be in a situation where you don't absolutely want to own it at that price. If you don't, get out. Why do you have it there? Why would you obligate yourself to be buying something if you didn't really want to own it? You got to remember what you're in these for. What we do is, whenever we review our portfolios, that's what we do. We look at each position and say, do we really believe in this thing? Look at Cheesecake Factory. They're below our targets. So do we want to get out? We're down 2,000 there. We're down about $4,000 on Cheesecake Factory. Oh my gosh. So what happened to cake? Okay, they're back in the bottom of the channel. And where's my thing? Here, cake. I think I was saying recently, I was just in one of these things. Now they're just $2 billion for Cheesecake Factory. They only make $100 million. Their PE. Look, the PE this year. Last year they lost some money. The year before they lost some money too. So last year they lost money. This year they're going to make a little bit of money. Next year they'll make pretty good money considering you're only paying $2 billion for the whole thing. So next year they make that money. If they're on track for this, I don't have a problem owning these going forward. They hurt here. They wiped out all these earnings here. Were wiped out in 2 years. But I didn't own them then. I own them now. Okay, that's also a very important thing to keep yourself in mind. Is I did not own them when they were $50. Okay, our cake entry, well, we don't own them at all, but our cake entry came in September. That's when we jumped. That's when we got interested in them. And oh, here it is. So in September, 1 year chart. So when they were down here in the mid 40s, that's when we started. That's when we got interested in and jumped into the thing. All right. And then what we do is we watch the earnings and we see what happens, and we decide what we're going to do with that position. Now, most likely, we're going to give them more time. We don't think anything's particularly wrong with the company. Earnings on November 3rd. So this reaction to cake in the last month or so, since we came in September, it's gone down a little bit, not much. Okay, so we had pretty good expectations. We thought it was coming higher, and we got all the time in the world for it. But the question is, what's going on? Well, it's not because of earnings. Nothing bad happened. There's no news that says Cheesecake Factory did something bad. Okay, so we don't know why it's down exactly. We'll do more research and find out. But we do know we like him as a long-term investment. So therefore, looking at this position, we have a we have a $40 put. So we were conservative with our put sale. We sold it for $670. So we have a $33.30 entry there. I'm not worried about that at all. And that brings us to the 2023 45-55 calls. So it was a tight spread. These guys are obviously on the way to expiring worthless. It's going to be hard to get back to 55 in a year, but maybe it will. But the point is, what can I do? I can salvage. Here's the key to these spreads. This spread was 20, I'm sorry, it was 1030 minus 660, which is what, 370? Yeah, 370. So this whole spread was 370. Currently, I can pull 640 out of these calls. So if these expire worthless and I cash these out, I'm up considerably to 640 from 370. But what I'm really going to do though is I'm going to take the 45 calls in cake and I'm going to take that 670, which is more money than I put into the spread. So I'm going to take the 670, it's not 670 now, 45s, it's less than 670, it's like 630 on this one. But I'm going to take that, I'm going to take this money, whatever it works out to, and I'm going to roll it. I'm either going to get time, and these will be like, let's say these are $9.50. So let's say these are $9.50. I'll spend $3 to buy another year, or I'll spend, these will be like $12. So let's say I'd spend $6 more. I'll double down and buy $5 in position and another year, which is kind of more worth it. Or maybe I will roll to the 35 calls, which are, let's say 13. All right, so let's say they're 13.50, and I would sell these guys 5 for 7, let's say, the 55. So if I go to the 35.55 for 13.50 and 7, that's net 650. 7 and 13.50 is 650, right? So what if I roll to that spread? The 35.55 spread is 650. I'm selling these for 650, so I'm just trading these calls to that spread. But then that spread would be, I've still got the short whatever's to deal with. I think they're the short 55s that I would have to deal with here. Now, I could either leave them hanging or I could move them around and shift them or something like that. I would move them because these Januaries are 220. So these are 220. The January 45s, which are a little bit over the money. So I probably move some of them to the January 45s just so they expire quicker. And I leave, let's say I move 1/3 and see how that goes. And if that goes well, great. But I also might buy some more spreads since I can buy these $20 spreads for $6, $6.50. Let me have some more of those, right? So now my target is the same $55, but I got these $35 calls at $10 in the money that I'm buying for $6.50. Not $10, sorry, $6 in the money. So they're 100% in the money for $6.50, and I can see a solid path to selling short calls against them and making a nice profit. So that's what determines whether I keep Cheesecake or not. It's not just whether I believe in the stock, it's do I believe in the stock and can I see a clear path to making a good profit on the position? And that's got to be a combination. They both have to be there. It can't just be because I like the stock. I have to also be in a position to make money. This spread is not in a position to make money, but I can fix it. And I can fix it for zero by taking these $6 and these $6.50 calls and rolling them to a $6.50 spread. That then leaves me with these at the short 55 calls are $3.65. Now, if the 2024s get to $55, that means these are going to be worth the 35s are going to be worth 20 each. I have $40,000. What's my net on the spread now? My net on the spread now is a credit. It's 12 minus 15 is minus 3 and 7. So this is a $10,000 credit at the moment. So my $10,000 credit would be worth, without spending any money, would be worth $40,000. That's a $50,000 gain if we hit 55. So if Cheesecake Factory goes back to 55 and puts these short calls in the money, I'm up $50,000 on my long. So I'm not going to cry about these calls being in the money, but what I would do is put a stop on these at about $5 on half. So my worst case scenario is I'd only have 10 of them that I would have to pay back over $5. So, you know, if you got to think ahead of what if this, what if that, what if this, and what if that. Meanwhile, these guys, these short puts, which are currently a net $15,000 charge against me, as this position goes up, that's where my credit comes in. As this position goes up, these become lower, and I make this $15,000 drops to my bottom line on the portfolio too. So I like this position. I like Cheesecake Factory, not necessarily because I think it's going to the moon, but because I think I can make a lot of money on these options. Therefore, worth keeping. That's how you make these decisions. You got to look at the big picture, not just one aspect of it. Neil says, did you add an IBM trade to a portfolio or are you still waiting? I don't remember. I know we talked about it. We talked about Intel and we talked about IBM, and I don't honestly remember if we did either one. I know I would have been more inclined to wait on either one. I don't like to jump into these things. So, yep, and that's why there's IBM still going down, INTC. You gotta let the people panic. You have to let the people who freak out about any kind of loss and start dumping. I can't take it anymore. It's below 50. I got to get out. Why do you care? You know, when you own a house that you paid $400,000 for, and it goes to and the value of the house drops to $300,000, do you move? No, you're using the house. You're going to be there for a long time. It would be nice if it got more in value, but you've got a use for it. I have a use for a stock in my portfolio. I don't, if I put it in my portfolio, and that's the thing though, that's a huge advantage that we options players have. Well, we option sellers have, not option players, option sellers, which is what we are. We are the house. And the advantage that we have in selling options is we don't care whether our stock does good or not. It's not important. We are selling premium. We're using our stock to make money. We are renting our stock out to people. So I have use for Intel. I have long-term use for Intel. People will always be buying Intel. And as I've talked about in chat a lot, and you were talking about IBM, same thing for IBM though. We talked about in chat a lot. These are companies that are going to be there for the next decade. They just happen to be in investing cycles right now. So there's not a lot of growth in the next couple of years. So if you want growth, you should be dumping this. If you're a growth person and you've got to have growth stocks in your portfolio and you're being measured, your performance, you're a hedge fund, and if your company doesn't grow, most hedge funds, you have to realize this, most hedge funds don't sell options. Most hedge funds buy a stock and the stock has to go up in value, or they look like a bad hedge fund. They don't have an alternative way to make money. So either IBM is going to make more money and either Intel is going to make more money next year and their portfolio will go up, or it's a bad stock for their portfolio and they got to get out of it. They don't want to tie up, let's say they have 1 million shares of IBM. They don't want to tie up $125 million in IBM if it's not going to go up $5 million next year. It's useless to them. If it's not going to go up $10 million, $12 million, if they can't make 10% on this stock next year, if their projection says it's not going to be at 137 next year, then this is a loser for their portfolio. There are people with huge amounts of money who are making completely different decisions than you are about whether to buy or hold a stock. The majority of them are hedge fund managers who don't want to hold anything that's not going to go up 10% next year. It doesn't matter how good the company is. It doesn't matter what their long-term prospects are. It matters that it's not going to make their portfolio look good next year. That's how hedge fund managers get tied up in their trading. They can't make a proper investment. They can't make something. It's got to be winning now. It's got to go up now. And unfortunately, though, those people transfer that anxiety to the board of directors and to the CEO and force this idiotic make money every quarter mentality. Nobody invests in the long term. There are strong companies like Intel, like IBM, most of the Fortune, most of the upper Fortune 500 companies like Amazon. There are strong companies with strong leadership that make decisions for the long term, that invest in the future. Even got to give credit to Elon Musk. Even Elon Musk says, I don't care about the day-to-day fluctuations of my company. I'm building a future. I'm freaking launching spaceships. That's what Elon Musk says. I'm building spaceships. I don't care if they don't make any money. I am building spaceships, and eventually they'll make some money. Jeff Bezos didn't make money for 40 years, didn't make any money. Now he's making money. He's the richest person on earth. So this, if you're going to be a long-term investor, you have to ignore that stuff. You can't succumb to pressure that your portfolio always has to do well, or that the stocks in your portfolio always have to do well. Now, meanwhile, yeah, we got out of IBM when 150 failed. We didn't get out right away at 150, but around 140, we got out of IBM because I said, this is not looking good. It's not strong, and they've got no prospects to do better. I said they're in a down phase. They're in a phase where they're investing their cash into projects that won't pay off in the near future. Therefore, we didn't want to be in it here. So we got out and took our profit. Now they're getting attractive again. Now 125 is definitely where we like to jump into IBM. But I'm not rushing in. Show me some strength. Show me a bottom of some kind. We're not in a hurry. Why are we not in a hurry? Because of what we were just doing here. Because we can always sell a put. This volatility. You know when it becomes a problem for us? When the volatility goes away. When IBM steadies up and the internal volatility of the IBM puts goes away, that's when we sort of miss the boat. But even if they steady up here for a few days, even if we get this kind of action and start steadying up, okay, we'll catch it and we'll still get a great price for the puts here, here, or here. Even here, the puts will still be elevated in price. If we let it go and it goes way up, then we miss the party. But we're not in a hurry to jump on. I'd rather be sure they're done going down than chase a false thing. So that's what we're looking at. And right now you get incredibly good money, much better money than you should get. It's stupid money. Like when we sold the apples when they were going down. Like that was stupid money. That's why we jumped in on Apple. Not because of any particular thing in Apple, but because we were being offered stupid money for the puts. And I said, why would I not want that? Why would I not want to sell the 105 puts for $8 or $7? and net into Apple for 98. That's all the question was. Why do I not want to net into Apple for $98? Of course I do. If you're going to offer that to me, I'm going to take it. IBM, same thing. If I sell the 110 calls for 13 bucks or whatever's in between that, 13, 14 bucks, if I net in for $97, the same thing as Apple, right? If I net in for $97 on IBM, of course I want to be in IBM for $97. Fourth, not a question. Cannot picture a scenario in which I'm going to regret that decision. Therefore, I want to do it. I'm interested now. It'll be nice if they drop some more, but they already had their earnings. So it's not likely. I don't think there's any more bad news, but they can be downgraded. People turn sour. Negative articles come out. You have to give that cycle some time to play itself out. You know, these people love to jump on. People love to jump on a big name that falls apart. So we just had the earnings. Look, paying 5% dividend too. Jesus, why would you not want this? IBM AI, blah, 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 cash dividend, blah, 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 Winnebago and IBM, what? It's a weird combination. Intel, rough road ahead in front of us, right, for the chip shortage. IBM, Adobe, IBM, despite disappointing. Okay, that's interesting. Let's see what that one says. What happened? So IBM lackluster results on Wednesday. Third quarter announced key numbers. Revenue flat. Net income $1 billion down from last year. Profit margin 6.4 is down. Large discrepancy between GAAP and non-GAAP. So non-GAAP was significantly higher. So for whatever reason, their GAAP numbers were not good. But they were there. What non-GAAP is they're saying now. A lot of companies non-GAAP, like Tesla, non-GAAP is bullshit. I wouldn't pay, you know, I don't believe a word he says. But IBM, when they say non-GAAP, I believe that they're saying excluding items that frankly we would have, you know, excluding items that we had to legally account for, but we don't believe should have been expensed. We made a lot more money. You know, certain investments they make are considered expenses, and they say, well, we disagree with that. We feel that this would have been a higher number. So. Tech services down 5%, software up, business services up, revenue down 12%. Yikes, that's nasty. All right, anyway, so nothing too exciting there. So are they a screaming bargain? No, they're in a slow period. They're investing, reinvesting, and they're turning the ship a little bit. All right, but meanwhile, though, this is an overall a good value stock. They are the market cap for them is $112 billion. They just made, I forgot now already what the number was. They just made $1 billion something for the quarter, and as I said, where was the number? Oh, income. $1 billion they made for the quarter. Okay, it was down 30% from last year, but they're saying if you look at non-GAAP, we would have made double. So there's a big discrepancy there. And then we look at what do we expect out of these guys? IBM. So this is interesting because I don't see how they get here from there. So now we got to look. See, and that's the thing. You can't just accept. You can't say, "Oh, look, $9 billion. Why is it $9 billion?" Well, there were $9 billion in 2019. They were $8 billion in 2018. So $9 billion makes sense. Last year was a bad year, of course. Why did they only make 1.3 this quarter? Let's keep in mind, IBM says it should have been 2.5. Interim. So what happened? Net income, 1.13. What did they in fact make this year? They're never going to hit it. They're never going to hit 9 billion. So that number is wrong. Because net income, here's your net income. It's 955, 1.3, 1.2 is 2.5, 3.5. They're not going to make. Here's a 2.5 billion quarter, 2.5 billion quarter, 2.5 billion quarter. Even if they make 2.5 billion, which by the way, keep in mind, non-GAAP, they're saying they would have made 2.5 billion this quarter, but that's what they should have made to hit their numbers. Even if they go to 2.5 billion next quarter, that's still only going to put them in for what number was this? I forgot now. 2.5, 3.5, 4, 5, 6. They're only going to hit $6 billion total dollars for the year. So they're nowhere near this projection. That's miles off. All right, so then you have to call that into question and say, well, maybe they're not going to hit that either. But it does seem that they're coming in at a $2.5 billion pace. It's just that it's a GAAP non-GAAP issue. All right, so it's reasonable to expect they'll get back to $9 billion, but in fact they're at 6. Can I accept $6 billion if they're a $113 billion company? Yeah, sure I can, of course. It's 20, not even 20 times earnings, below 20 times earnings. It's pretty good. It's not where we want them to be, but we can make a case where they'll get back to 10, and then they'll be at 10, 11 times earnings. So solid pick, not a screaming buy, clearly issues to be worked out, and they're in an investing cycle. So you're going to have a lot of this GAAP, non-GAAP stuff going forward. It's not going to jump up. It's not going to jump back in value, but that just means I would set up a trade with low targets. You know, and like I said, if you want to tell me that I can sell the $120 puts for $18, or that's a little more aggressive, or the $110 puts for $13 and net it for 97, I consider that free money. I'm happy to net in it at 110. I don't care if it's 110, but I'll consider the $13 free money. So I sell 10 of those. I obligate myself to own $110,000 worth of IBM. I pick up $13,000. And then I say, well, what do I think is going to happen? I don't think that they're going to be that much over one. I don't think they'll be like 130, 140 too easily. So let's say 130 would be my goal in a couple of years. So these are, let's say, 1150. And how much did we say we collected? 13,000. So I could easily go to something like this spread, 110, which are well in the money. So the 110, 135, which is a $25 spread, and it's roughly 11 bucks for the spread. So if I bought 10 of them, that's $11,000. If I bought 20 of them, it's $22,000. If I bought 30 of them, $33,000 minus the 13,000 here. So that would become $20,000. So my net on the whole thing would be $20,000, and my upside at 135 would be 30 times the $25 spread, $75,000. So I'm spending net $20,000 on a $75,000 spread. And since I have 30 long spreads that are going to make me $55,000 if all goes well, I got no problem selling. Let's see, we're at 125. I could sell 10 of these, the 135 calls for January. Because if IBM pops back up, I'm just going to roll them along. But they got the 135 calls in January. If I sell 10 of those, I get $1,000. And I can do that over and over again. Now, if those hit the June calls, to the June 155 calls, by the time it's the same price. So I could roll to those calls. By the time we're 155, I'm way in the money. I could even just buy more spreads if I want to at that point, because I'm going to make I've got $55,000 coming to me, and I'm going to keep rolling these guys along to higher and higher strikes. Do I like IBM enough to do that? Yes, I do. So therefore, I like that strategy. Therefore, I'm not worried about IBM going higher. I'm only selling a third, and every time they don't go higher, I keep $1,000. If I keep $1,000 10 times over the course of 2 years, I cut my net in half, and I'm only in for $10,000 on the $75,000 spread. So I have a good chance in this spread of making, like $60,000, $75,000. Just if IBM goes to 135, it was a 110, 135 spread. IBM's at 125 now. So why would I not want to do that? And what's my worst case scenario? My worst case scenario is I have to own IBM $410,000 shares. Does that bother me in my long-term portfolio? No, not in the least. Therefore, good trade. Robin says, my cash is in a savings account for liquidity. My husband says I should not have all my cash in one place. Well, I mean, I agree with that. Certainly not all your cash should never be in one place. But, these accounts are insured just like a savings account. Your broker account, talk to your broker about what kind of insurance they carry. If you're leaving yourself with no margin in your trading account because you have cash sitting around doing nothing in your savings account, that's probably not the best use of your cash. You're just costing yourself money. The broker account's not uninsured. There's a backing to it. And again, I wouldn't put all my money in there. You certainly you should always have in your savings account enough money to go for like at least 3 months. Like covering all your expenses for 3 months should be in your savings account. So God forbid the world ends again. I'm a New Yorker. 9/11 happened. We were there. There was no phone. There was no cell phone. There was no ATM. There was nothing. Okay, there were no services. You couldn't get off the island if you're in Manhattan. There was people were evacuated from downtown. You lost your home. So yeah. When I say that, because you got to be able to pay your mortgage, or you got to be able to go get a hotel. You've got to be able to leave. You don't want to think about stuff like that, but something horrible can happen. There could be a terrible viral outbreak, something much worse than COVID, and you've got to leave. And if you have cash, you can probably get to where you want to be. You can go to I go to Whistler or someplace like that. If I really had to get away, I'd go to like Whistler up in Canada on the other side. Or I like Tahoe too. I mean, it's like, but I'd want to go to a place that's fairly remote where people live far away from each other, where you can get a hotel where there's not that many people, a cabin somewhere. But then you got to survive, right? How long are you going to be able to be there? So if you don't, you have to have some money available to be able to get out and do something, to be able to like move and get stuff done. But meanwhile, the joke about 9/11 was the banks weren't even open. So what was the difference? You have money in the bank. No matter what bank your money was in, it was open. But of course, if you had your money in Lehman, you were screwed, right? Because then it's falling apart. Look, nothing's going to help if it all hits a fan. In a catastrophe, your Swiss Army knife and your water filter are going to be a lot more valuable to you than your cash if it all falls apart to that extent. So I wouldn't spend too much time worrying about it. But like I said, a nuclear bomb could go off somewhere. A terrorist attack on the banking system, financials could get shut down. Who knows what happens? Good to have money accessible, a few months worth that you can go with. If you're the richer people are, the more they have shit like this. I know people who have this, like $100,000 in a safe. I know people who have gold. They got jewelry, they got rings, they got this, they got that. I'm like, who's going to appraise your diamond? Where's the sense of this? Where are you going? What are you thinking is going to happen that you're going to run out of town and grab your jewelry and that's going to be what you're going to live on? I'm like, how are you going to live on it? Where are you going to take it? How are you going to, what are you going to do to trade your diamond for something? And the thing, it's, gold maybe, maybe having some gold bars and some Krugerrands and whatever, that makes sense because pretty much any kind of meltdown in civilization, we can go back to that. But selling jewelry is a tricky proposition, getting your values worth out of that. Gold will be gold and people will have a value for it, although you still won't get a good price probably. And cash is cash. It's just, you have to have your own survival skills if you're really thinking like that. So yeah. So, I do. Well, so while I do think that you should have money in the bank, I think the point is, if in the horrible circumstances where society just keeps going along normally, then what the hell are you doing paralyzing your money? You're killing your earning power of your money just in case something horrible happens. It's extremely unlikely. Let's see. JC is saying, I signed in late. If you haven't discussed Viacom, please do so. Well, we just did that in chat. Oh, and Neil says about so Neil, yeah, absolutely. In chat, just definitely remind me of IBM and Intel. I think we should probably by the end of the week take a close look, because they're both just very attractive now. Might get more attractive next week though. We don't know what's going to happen. Again, I want that GDP report before I do anything else. Let's see where we are. What were we talking about? Viacom. We just talked about Viacom as much as I really think it's necessary. Webinar's almost over too. Aha. Look at that. Boy, things are going fast. La-da-da. Okay, here we go. Viacom, you're just talking about it. Boeing, no, where the hell was it? That was IBM. Oh, here's Viacom. All right, so we were talking in chat about Viacom, and look, it's stupidly low. Again, it's the same crap. Viacom is ridiculous. I mean, their PE is like 5 or 4. There's no indication at all that there's a drop in earnings or that anything's wrong with these guys. They're just heavily out of favor with the entire telco sector. Look, AT&T is, I'm so sure. Look, AT&T. Whoops, get that back. Comcast, CMCSA. Everybody. It's not just Time Warner. I mean, it's not just Viacom. So, people are just getting, these companies are just getting sold off, and there's nothing wrong with Viacom in particular. They're just part of the same sector, and everybody's dumping it. And again, like I said, hedge funds, VIAC. So it's hedge funds that are just being like robots. They're dumping telcos. They're dumping communications companies for whatever reason. They're all panicking out of these things. Let them. Doesn't change. Again, it's a house. If I live in a house and you tell me my house, you go up to me and say, "Hey, Phil, your house is only worth $350,000 a day, and you bought it for $5. Ha ha ha! You better dump it." I'm like, and do what? And go where? I've lived in houses long enough in my life to know that they go up and they go down. It's the same 4 walls and the same kitchen, the same this and the same that. It's the same distance from the school. The stores around me don't change. The neighborhood doesn't change. The house price goes up and down. Does it change, does it change my mind about living in the house if I have a use for it? No. So if you have a use for the stocks in your portfolio, the price of the stocks should not change your mind. The problem is most people don't have a use for them. They just want them. The only thing that they see from these stocks is that they go up in price. If they don't go up in price, it's not doing them any good. All right, you got to be more mature than that. You've got to be past that. You have to be smarter than all the idiots who jump in and out of things. And you've got to learn how to be the house and how to collect money for your ownership. You're willing to own Viacom. Okay, just like I'm willing to own ski condos. I used to own lots of ski condos. I used to rent them out. Okay, I rented them out and I basically broke even all on these condos. People were saying, "Well, Phil, why do you own them? You're only breaking even." My accountant said that to me. He's like, "Why do you only break even?" And I'm like, "Well, you know why? Because every weekend in the winter, I decide where I want to go, and I go, and it's free, and I pay nothing. Instead of paying $3,000, $4,000, whatever for staying 3-4 days in a luxury resort, I have my own very nice 2-bedroom, 3-bedroom thing. My whole family gets to go, and we hang out for as long as we want, and we ski, and then we go to the next place. And I can go to Aspen, and I can go to Vail, and I can go to Killington, and I can go to Hunter Mountain. Anywhere I want to go, I can just pick up and head over to one of my places. And I just tell the management company I'm not renting this weekend, blah, blah, blah. It's not that it's not, you have to plan a little bit more in advance, because if they rented it already. But that also, I'd say which one isn't rented. That was the other thing. I'd say which one isn't rented. If the conditions were equal, I would just look at my properties and say which one's open. If one's open, I'm like, let's go use that. It's open. I would give it out to my friends. I would give it out to my clients. I had use for it all the time. I found something to do with it that was worthwhile. And the rentals were great, though. If I didn't use them, I would make money. If I didn't use them at all, make money. Okay, but I got the use out of it, and I got the property for free. Everything paid for, taxes paid for, maintenance paid for, everything, because I rented it out most of the time. Same thing with your stock, rent it out. Don't let it just sit there, rent it out. Then you've got use for your property. If you just watch it go up and down and you don't do anything with it, then all you should ever do is buy low and sell high. And that's the other thing, is if you're not going to sell high and you'll only panic out low, of course you're going to have terrible performance. You got to have the discipline to look at the long-term chart and say, well, down here is where we buy. On this line is where we buy. It didn't work out this time, but generally, this is where we buy. And you know what? This is where we sell. We buy here, we sell here. If you do that, you have a very happy time. If you buy at 38 and you sell at 42, you make $2 here. You make $2 here. You make $2 here. You make $2. Well, no. All right, so you make $2 here. Let's say you bought here, and now you're finally taking a loss. But that was what, like $8 profit. You take a loss of $1 and you stop out. You still have $7 for the year. Now, if you would bought it and hold it, you never hit $7. Or if you timed it perfectly, maybe this stretch right here, if you timed it perfectly. But if you don't sell there, if you always think it's going to go higher and higher, and you don't sell and don't take a profit, never going to do you any good. You're still better off on the whole, though, playing the channel. Play it over and over and over and over again. And when the channel breaks, you stop playing. That's the discipline. Don't play when the channel breaks. Wait until a new channel is established, then play that. But as I was saying, we got to wrap this up now. So with Viacom, unlike their competitors, HBO, Hulu, Netflix, whatever, they own CBS. CBS has 4.3 billion subscribers. Okay? Everywhere, everyone with a TV pretty much has CBS as one of their choices. They also own in other countries. They got Channel 5 in Europe. They got whatever this is in Israel. They got this thing in Australia. And they've got Showtime, which is also all over the world. They've got MTV, 175 countries. 175 countries. I think there's only like 220 countries. How many? Nice typing. How many countries are there? 195. See, we seem to have destroyed some countries. I swear there used to be more. So out of 195 countries, they're in 175. They're in 175 with MTV and Nickelodeon. Comedy Central 145. That's pretty good, actually, considering comedy's a little bit subjective. And now they've got the streaming service and paid TV. They now have Paramount Plus as well. CBS is the #1 network. And they have their affiliate network that pays them money. So in other words, the local broadcasting stations also pay them money as an affiliate. Local advertising, so on, news, things like that. So you can buy the whole thing for $24 billion right now, and they make $4 billion a year. What is there to talk about? The only thing to talk about here is what idiots these people are. They don't know, they wouldn't know a good stock if it bit them in the ass, obviously. This chart is not in any way, shape, or form going to influence my buying decision. In the same way that you telling me my home is only $350,000 when I bought it for $500,000. I don't care. I know what it's worth. Do I wish I had bought it for less money? Sure I do. Of course, I would have rather bought my home for $350,000. I didn't know because at the time I bought it, that's what it cost. And until somebody's willing to pay me $500,000 for it, I'm going to keep it. This is why we diversify. No single stock should be bringing down your portfolio. This should be just one of those things. This particular stock is not at this particular time performing. But give it time. Let them earn another billion, another billion, another billion. In 24 quarters, in 6 years, they will have earned the entire amount of money you paid for the stock. Everything after that will be a bonus. And they're not cheap. They're paying it out in dividends too. So what's Viacom's dividend? I forgot. Yeah, only 2.5%. So they're paying $1 though in dividends. But $1 isn't much, so I wouldn't be too worried about it. So in other words, if I buy Viacom, it's $36. Okay. And I'm going to collect $1 in dividends. So that's $2 in 2 years. I'm going to sell the 37.50 calls for $6-7. Let's say $7. All right. Is that 37.50? Yeah. So I buy it for 36. I sell these calls, the 37.50s, for $7. Well, let's say it's for $6 even. I don't care. So that nets me down for 30. Plus, I'm going to collect $2 in dividends. My net is now $28. All right. That's just straight buying the stock and selling these calls. My net is now $28. I get called away at 37.50. And that's 950 divided by, what did we say, 28? That's 33.9%, so 34%. So basically, if I just buy the stock for $36, I sell the 37.50 calls for $7.50, and I collect my $2 in dividends, I'm going to make 17% a year just owning the stock with a covered call. Now, if I want to also pledge that I'm willing to buy twice as much at 35, and I sell those for $7, now I've dropped my net. I've increased my take by 350 per year. So it goes from what are we dividing into? 28. So now I'm going to collect instead of 28, it's going to be 21. Right, $7. Did we say? Yeah. So $7. So now my net is 21, and I'm still getting called away at 37.50. So it's whoops, how much is that? 1650 divided by 21. Now making 78% in 2 years, 39% a year on my layout. And in this case, though, I'm now promising to buy. I did buy the stock for 21. Plus, if I get assigned 35 divided by 2 is 28. So it's really the same 28 that I would have done if I had just done the straight covered call. I would be at the same 28, but with twice as many shares, but it's the same entry position, except that if I do get called away at 37.50, which is not much higher than it is now, in 2 years, I'm going to make twice as much money. I have twice as much percent on the cash outlay. So do I not want to do that? Do I not want to make 30 whatever percent a year? 39% a year? For holding Viacom and hoping it goes 5% higher over 2 years? So yeah, of course I want to own that. Why wouldn't I want to own that? Am I worried about owning it at 28? Am I worried that $28 is $8 lower than it is now? It's more than 20% lower than it is now. It's about 25% off the current price. So my worst case scenario, owning it for 25% off. My best case scenario, I get called away with a 39% per year profit. It's a reasonable stock with a very high chance of success. So I love it. That's all there is to it. It's not complicated. You got to look at the risk reward of a stock and the position and decide whether it's worth taking a chance. If you are worried about it, don't do it. Find something you're not worried about. Find something you do actually want to own. But to me, I can't imagine what, I just don't see many things I want more than that. All right. Running out of voice, so that's a good time to call it quits. Thanks everybody for coming. I appreciate it. And next week for sure, let's make sure we have IBM and Intel, but I'm sure we'll have a top trade alert going out on both of those. All right. Thanks a lot for coming, everybody. We'll do it again next week. And have a happy Halloween.